talk us through what has been certainly whipsaw when it comes to the markets, Dwyfor, and the U.S. seeing this continued bloodbath when it comes to equities. I'm just wondering, are you seeing any signs that this drawdown we're seeing in January is coming to an end in any way?
I think that's a little premature to suggest that. I think we really need to get, stating the obvious, but we really need to get this Fed meeting out of the way. There's obviously a couple of things we're looking out for here. In all likelihood, they will do absolutely nothing tangible this evening, but tomorrow morning by the time I guess by the time we get it. This is really a signaling meeting. They tend to signal in advance when they're going to move. They didn't signal an imminent move in December, so we shouldn't expect anything this time around. But they should be creating a sufficiently robust signal for the markets today that they will move in March. And that is basically where we are in terms of the Fed. In and of itself, I'm not entirely certain that should have that much of a bearing on markets. That by itself has now been largely discounted and priced in. I think what's really hitting markets here is the combination of monetary tightening, by itself probably not sufficient, but also overlay that with the geopolitical risk coming out of Russia and Ukraine. And that has had quite a significant impact on sentiment more generally. And frankly, given what we're seeing right now, there doesn't seem an imminent sort of end to this because the geopolitical risks are playing out, and we don't really know the extent of the hawkish bias of the Fed. So we really need to get this Fed meeting out of the way. Things might calm down a little bit if the Fed indicates a gradual tightening process, which is what is basically priced in. But that still doesn't, I guess, alleviate the issues from the geopolitical risks, which are just continuing clearly.
Right. How do you square what has been quite hawkish pricing from the Fed with the policy easing that we're getting out of China, which it seems to be that they're leaning all in almost in terms of trying to avoid some sort of collapse in credit? Does that bode well, at least for this part of the world?
You would have thought so. If you look at equity markets in APAC right now, in Asia right now, you wouldn't think so. But actually, you would think that the big change that we've seen from last year to this year. So last year in China was clearly regulatory crackdown, common prosperity. This year already we have seen a focus on the aggregate growth story, and that was reiterated again from the Chinese Prime Minister yesterday. Monetary conditions have started to ease. We also expect fiscal conditions to ease as well. Fiscal spending, the impact that will have on infrastructure spending in China, and the positive spillovers that will have on the Asian market. So on the one hand, markets in Asia will struggle in an environment of tighter global liquidity, but there is a little bit of ray of hope that China will continue with its credit growth cycle. Now, that will not be as aggressive as previous cycles, but it should give a little bit more it should put a little bit more emphasis on the region that it can ride out some of the tightening policies that we're seeing elsewhere. So China does, in a way, it has a very important role here in steadying the ship as far as the broader Asian markets are concerned.
Yeah, Dwyfor, in fact, the two sort of major themes that you touched on there, I just want to get your thoughts on where those themes are in certainly 6 to 8 months from now. So peak inflation, have we seen that? And peak growth, do we get to push that back because of what China's been doing with monetary policy?
So peak inflation, frankly, remains still a work in progress. So some of the indicators that we have proprietary indicators at State Street where we track high-frequency inflation indicators, and there certainly was an indication towards the end of the year that we were hitting the peak in the annual sort of year-on-year rates. The only question mark against that is if we then assume that we get sort of average monthly rates over the next 6 to 12 months, those average monthly rates will actually push us down back towards around 3% for U.S. inflation, for example, which is perfectly acceptable as far as the Fed is concerned, given its more flexible approach to inflation. That's assuming average monthly rates going forward. Now, of course, the base effect is much higher this year because the monthly rates in 2021 were very, very high. However, what we've actually seen in the early part of January is actually stronger prices than we anticipated. There are a few sectors still that are posting very large price increases, electronics being the real standout. And so as confident as we are that the trajectory of inflation is to head lower, it may not be heading lower at the same trajectory that we thought maybe even 2 or 3 weeks ago. Maybe there's still a bit of upside pressure there, but I think we're close to the peak in terms of in terms of prices. And in terms of that's from an inflation perspective, but elsewhere, in terms of the 6 to 8 months outlook in terms of growth, that will really depend on the extent to which central banks actually tighten policy. There is, of course, in some instances, a reluctance to tighten policy in a number of markets still in the G10 space. Look at Japan, look at the Eurozone. Right. These guys are not going anywhere. And to the extent that they are not yet on a tightening cycle suggests there's still going to be ample liquidity out there. So growth will remain quite well supported this year.
Well, yeah, I was about to say, I mean, the RBA and what happened with the market reaction to that inflation print out of Australia yesterday seems to suggest that markets are still sensitive to some of these inflation reads. Let's set aside the Fed, for example. I mean, have markets figured out other central banks at this point in time? I'll even throw in Singapore to that.
Yeah, well, there's a big divergence going on now. So the G10 market is actually quite an interesting way to look at things right now, because usually you would have a close correlation between markets in terms of their growth outlook and in terms of their policy outlook. And when you think about certain markets where we are expecting stronger growth, for example, the likes of, I'm picking one here from the G10 space, something like Norway, for example, and yet the expectations on rate hikes out of Norway are actually quite muted. Compare that with something like the UK, where actually rate hikes are now getting rapidly priced in because of rising inflation, but actually the growth outlook in the UK is actually very modest. So what that basically means is that there's a real divergence going on now between policy and growth in a lot of the G10 spaces. So you're getting this sort of two-speed track between a lot of these G10 central banks. I mentioned the ECB and also the Bank of Japan. There are others as well that are way behind the hiking cycle, and those that are obviously front and center, such as the Fed, Bank of Canada, for example, that are way ahead in terms of that cyclical approach.